I'm delighted to invite Steve Hunt to share his ESCO modelling presentation, and I think Joe's going to join Steve for questions later on. Yeah, brilliant. Okay.
Hello, everyone. I think I know quite a few in the room, but for those who don't know me, my name is Steve Hunt of Ener-Vate, and the first slide is a quick introduction of Ener-Vate. I won't take too much of your time on this, but myself, Joe, and our other colleague, Steve Marsh, we worked at one of Vital's opponents or competition up until about 2 or 3 years ago, and we broke free because of the niche that we saw in the market, that advice wasn't being given to customers and clients in the way that we feel as though it should have been. And that sort of hunch in our market, Joe, has been proved to be right so far. We're an independent group, just the three of us, and we work over in all over the UK, Scotland, right the way down to London, which is obviously a hotbed for us in the market. So we've both got our cards, and if you want to speak to us at lunchtime, that would be great. So I was interested to hear your chicken and egg analogy there, which is the obvious one. What we try and do with commercial modelling, and the approach that we take to commercial modelling, and we've seen them all. We get things across our desk that are fabulous. We get things across our desk that are total muddles and need sorting out. And what we've tried to do in the sort of the 10-15 minutes that we've got here for commercial modelling is to try and just structure how we go about what we term as a commercial modelling exercise. It's a huge subject, and we could take hours on this, in all fairness. But what we try to do is, what we've expressed here on this slide, and what we try to do is to make sure that any commercial model is only as good as what the drivers initially are with that commercial model, and who is making those drivers, and what are the most important drivers. You see the line across the bottom, the input level there. If you have multiple inputs at that point, then it's certainly going to create a very, very difficult model to get to the end of. So if you can imagine, if this triangle here was almost a square and you had lots of inputs to your drivers at the bottom, then it makes the task of making a commercially viable model even more difficult. So what we try and do is work in this hierarchy, say, well, what are the actual drivers, and really focus in on those, because sometimes they get lost. Once you get 2 or 3 levels up this modelling exercise, your initial drivers sometimes get lost, and you have to bring people back to those. And we'll go through each of these individually in a few moments. But the point about drivers as well is my favourite phrase is, a camel is a horse made by a committee or designed by a committee or something. And so if you start with that multiple input, you will end up with a very much messy commercial model at the top end of it that really doesn't actually create the solution that you wanted initially. So very much drivers are very important. We've got to get the drivers and concentrate on the drivers, but don't make them too wide. We can always add to those in the future once you've got something in the ground. So, working our way up the hierarchy then. Obviously we talked about planning and the impact that planning has. So many people, what the driver is, there's a planning policy to achieve here, so that's obviously a driver. What is the planning policy? Carbon reduction, as an absolutely obvious one. It was interesting to see your slide as well, Polly, about your first driver there was customers and customer cost and reduction in customer reduction cost. And to me, that is almost the important one, because we talk about district heating and the imposition of district heating sometimes onto customers and authorities, etc. If people want it, if people make an effort that they actually want district heating, a lot of those problems go away anyway. So we've got to make it district heating viable for customers and a driver for customers to actually force developers to say, we want district heating, please, and developers will certainly start playing that ball once they know that it sells houses. So very, very important point there. Other developers that we talk to, especially down in London there, are the first mover in the market. If we've got to do district heating, well, how do we do district heating for the benefit of the developer and the development? And we are working with customers now who are looking to be the ESCO and want to be the ESCO. If there's going to be district heating there, what's their piece of that pie, etc. So they're looking at as the first mover. And that retains value then. So they build the house and they sell the house and they can retain that value in operating and supplying that house for the longer term. And that's the sort of area that we are looking at for particularly in London. Also, that can increase and enhance their branding. So a particular customer we're looking at now down in London wants to be somebody homes ESCO, and that enhances their brand. It reclaims that customer for the longer term. And so all these are drivers that go into that market, into that commercial model. Lower energy bills, as we said, and then sustainability and security of supply. We'll talk about security of supply in a minute. So all those are drivers, and there's possibly many, many more, depending on the project itself, and on who is developing the project, which is a later slide. The demand is also important. We talked about, in the Leeds case, they talked about where the demand was and how secure that demand was, and if that demand was residential, or if that demand was commercial, or what it is. Because that has a massive effect on any commercial model, that the type of properties that you are supplying, residential, commercial, or industrial, all have their advantages and disadvantages, depending on what the drivers are, as we go back to the drivers and what you're trying to create. Are they new build houses? Are they retrofit properties? The actual data that you are assuming, is that actual data, the work that the councils are doing for feasibilities, is that a feasibility driver, market awareness, or is that actual data that you can rely on? And there's a lot of work to be done there in actual security and data of demand. We're not a big fan of commercial modelling on assumed load, because assumed load is absolutely nothing without engagement with that particular customer. So it's a huge point. The security of the demand and the commitment, in fact, in my opinion, is that's the cement that brings all the commercial models together. If you know that you have got that demand and you know what that demand is on a daily and an annual basis, then the commercial model tends to flow a little bit better from that point. But the security and the buy-in and the tie-in of developers and committing that demand to the project is absolutely essential. You've got the drivers, you've got the demand, you're looking at where the demand is, then the initial technical solution. The technical people in the room might disagree with this, but in my opinion, in our opinion, the technical solution doesn't really need to be involved until this point. You look at the demand, you look at what you're trying to achieve. It's only then that you start looking at the initial technical solution. Without going too technical from a vital point of view, REBA stage 2, something like that, at that point becomes the required sort of input from a technical solution. And that's obviously, we're still on the hierarchy, we're still looking at the drivers as the base requirement. And so the initial technical solution has got to meet the driver. So carbon definitely comes into that, the planning definitely comes into that. So it's not just a technical solution to meet the demand, but how that demand is met in the carbon targets. That then obviously determines the plant size and the phasing, and determines the network size, scale and phasing. At this point, I think it's very wise to say that what we try and do, or what is best to be done, is that an initial project can be developed with secured load, with known demand, with known drivers, that can actually get developed to a detail that could actually get then traction in the market to attract the likes of Vital or anybody else to operate and maintain. Future expansion of that and future additions to that and future opportunities to that should come at this point, after you have made the initial selection of what you're trying to do, got a model that provides what it needs to provide for whoever's providing the investment, and only at that point do you then look at future expansion and what that can be capable of. And so the initial technical solution should look at what we're going to build, how we're going to build it, and then what are the future possibilities for that network. And so pipe sizing obviously comes into play at that point, and the expansion of pipe sizing and where that could go in the future. But don't get too lost in what it can become. Make sure you develop something that you can actually develop and then expand in the future. We then come to the dynamic modelling and structure. So we know what the drivers are, we've got the demand, we know what the initial technical solution is. We then have a dynamic model that we put together. The dynamic is quite important as well. So we've got the initial costs on the industry metrics, so we know what the costs are generally at that point. We can engage with the market at that point to see what the costs are technically from a REPEX and a CAPEX and OPEX point of view. We can look and assess business rates, what they may be, if it's a large scheme, if there's anything like EU ETS involved, anything like that, which is the European Union Energy Trading Scheme, if I remember, that may be affected by larger schemes. And whatever that becomes post-EU, etc., we need to look at that. And then we need that model that's created to be very, very flexible, because as you all know, whatever you create one day, it'll be out of date by the following week. And so you need a model that is very, very flexible, very, very easy to flex. So you put in details in the models to say, well, if CAPEX was 10% higher, if OPEX was 10% higher, if EU ETS was involved, if business rates suddenly doubled, whatever it may be, that you can look at that model in a very easy way to say, well, these are the effects, these are the risks on that particular model achieving what it needs to achieve. It has to perform those sensitivities and stress tests very, very easily, not a whole 2 weeks work on a new model to try and find out what it is. Get the model, get a very easy front page on that model, and then flex to what the future will say. You can do a sensitivity analysis through the SWOT analysis procedure to make sure that all the risks are looked at. Look at all the opportunities, as we've said, private wire opportunities from the energy centre, things like that. But let's not forget that the original model needs to achieve the base demand and the drivers. That don't ever forget that the drivers and the demand is what we're trying to create. Everything else goes on top. At that point, I can't remember if it was Polly or Amy said, we then look to the market. And depending on who the ESCO is, which is the next slide, which I'll come on to, we can look at the market engagement in a more focused way. As I said earlier on, we get things on our desk that are complete nonsense at this point, that none of these things have been taken into consideration. Drivers are all over the place, the demand is not secured, and so on. And then the market sort of turns around, and you could ask 5 people and you get 5 completely different answers, and then where'd you go from there? If you've got these pieces of hierarchy in place, then it's a lot easier to get a focused reply from the market that you can make analysis of. So market engagement should be the last thing once these hierarchical processes have gone through. It gives a clarity of scope and the structure. It gives clarity to the investor on risk and rewards. And at that point, obviously, yeah, they might come up, the market might come up with an innovative way of providing the scheme that you hadn't thought of at that point. So you can seek innovation at that point. But very much the last point of call. And if you remember the original slide, that's when you get more and more input. As you go up the triangle there, you get more and more input from different people as the hierarchy gets climbed. So all those things are all well and good and all fine, and everybody sort of understands that to a certain extent, but who is the ESCO? So viability, what's that mean? What is viability? Who is trying to create whatever they are trying to create? So it's very important that all those previous steps are done in a way that you understand who the ESCO is in the first place. So if it's a publicly owned ESCO, the drivers and the returns and the investment might be one thing, but if there is a utility company involved, there might be something else. If it's a private sector developer, they might be completely different. And so I nearly put this slide right at the beginning, but I thought it's a little bit of a nonsense slide without the context of what I've just been saying. all those decisions that have been taken so far is absolutely critical on who the ESCO entity is. It may even be that the answers that you get from the hierarchy as you climb, it creates the entity and make it more likely that the entity should be public, or it should be private, or a community, or a joint venture of whatever it may be. But it's critical not to create a model that looks all well and good from a public point of view, but has got no chance whatsoever of including anybody from the private sector and the returns. And so the ESCO entity itself is a very, very important decision to make on whatever the modelling needs to be. As ever, not trying to teach you to suck eggs here, but a balance of risk and reward is obvious, and so the returns made on the investment made need to have within it their fair share of risk and reward on that. The ESCO entities need to establish ability to deliver and identify the risks, prepared to accept or flow down through subcontracts. And so what we are seeing more of in the market now, from Ener-Vate's point of view, is that more and more private developers, particularly in London, are assessing this whole district heating opportunity, as they call it, and not then just going out to the market and saying, come in as an ESCO and create this 40-year term to supply our customers. They're actually saying, well, actually, we'll be the ESCO, we'll invest in that infrastructure, because we might have to invest anyway, and we'll employ the likes of Vital through D&B and O&M contracts for the duration. And they are now understanding more and more that there is a value to be created here. And so they need to be aware of and identify the risks to them and their brand. And we've seen a lot more of that sort of engagement, particularly in London, maybe in Manchester in the future if the planning policy goes that way. The modelling that we do, there are obviously different types of model that you can put together in the sense of investment and recoupment of investment. I'm sure you may be all aware of these, but there's a connection fee model in that the ESCO, whoever the ESCO is, the entity that is created to be the ESCO, puts in the capital in the first place, so cost of capital obviously comes into play in that sense, and then they receive a connection fee from anybody connecting onto that network. And so it's very much front-loaded from a capital point of view, and as the build, if it's new build, progresses, then a connection fee is paid to the ESCO. Contrary to that is a contribution, and so if a developer chooses to either be the ESCO or put the ESCO out to the market, they then pay for the capital required, and the ESCO then, whoever it may be, can pay a contribution back to the ESCO once it has adopted the plant for operation. I think it's fair to say, Nick, I don't know about you, but we're going away from that a little bit, specifically in London, where there is probably higher pressure and higher publicity on the actual cost to customers, and therefore some ESCOs are sort of walking away from the contribution, and that benefit from the ESCO point of view would be passed on to customer cost and tariffs rather than them receiving a contribution. But again, horses for courses. We'll have to look at each one of those individually. There are also more developments now that separate the network ownership, and therefore the ESCO can be the ESCO. The ESCO can invest in and get the connection fees or contribution as they need and want. But the actual network that goes in the ground can be owned and operated, or owned and operated by the ESCO, by a separate entity, pipe co, underground co, whatever you want to call it, which takes out a lot of capital early doors from the ESCO's point of view. And then the ESCO pays a HUOS, a heat use system charge, to the pipework owner for use of their system. And that maybe sits nicely with public procurement and public ownership and lower returns and expectation for pipework such as that. Some schemes very much lend themselves to that kind of innovation or investment. Other schemes not so good. But again, we'd have to look at each individual scheme for the benefits. And then there can be obviously hybrids of the above. The size and nature of the scheme obviously really determines what the best route of investment is. Smaller schemes tend not to be conducive to pipe separate network ownership. For instance, it tends to be the larger schemes with a large amount of pipe, but that's not to say it can't be done. But there's one thing, there's no one size fits. Every single one that probably I've ever been involved with, Vital ever been involved with, it's a different model. It's a different horses for courses. It really is. Whatever you need it to be, whatever the drivers are, whatever the carbon targets are, whatever the investment is, whatever the returns on investment are, they're all different. And it is, as you said earlier on, a minefield. So, to sum up the slides, really, what I've tried to do here is build from the bottom up. Don't get too hung up on the top end of the technical solution before you need to. A lot of feasibility studies are very technically based with absolutely no basis whatsoever of what the customer is going to pay, what the investment return is going to be. It tends to be, I think the industry was built from a technical point of view historically, and so it tends to be a little bit more technically focused, in our opinion, than it needs to be, especially when you are developing from a feasibility point of view. So keep it focused, build from the bottom up. Any expansion from what you're currently modeling should add value. It shouldn't be one of your drivers. It should just add value to what you're already building. Identify the optimal ESCO entity ownership. That's either at the beginning of the scheme or as you manufacture the commercial model, the ESCO entity ownership perhaps becomes more clear on who that may be. And then you put the commercial structure in place to suit that, and which balances the risk and reward between all the parties and stakeholders involved. Oh, I said stakeholders. I don't like saying stakeholders, so that's a mistake. Apologies. And then define the drivers and the metrics of viability. We said earlier on about viability. Well, there's 40 people in this room, 50 people. You probably got 40 different answers of what's viable. And viability commercially sometimes isn't viability from a risk point of view. You've got to balance all that off. So make sure it's defined early what the drivers are, what the risks are, and the viability comes from that. Security of demand is absolutely essential. Nobody's going to invest in anything unless the security of that demand is there and signed and ring-fenced, if you like. So planning policy will play a great part in that. The source of finance is obviously important, the cost of that finance and who is investing. The term of the contract, 25 years minimum, 40 years typically in the ones that we've been involved in. I know of ones longer than that down in Exeter, for instance, probably double that, 80 odd years. And once all that has been created, once all that has been developed in the way that we suggest that it is, you can then focus the market and in terms of the engagement to get better returns from the market to fit what you're trying to achieve. But the whole message of this, the whole message of the of what we're trying to create here is that try and keep focused. Don't get lost in what this could be in the future. Try and get something that's built from the bottom up for the right reasons, with the right risk, and then add value with expansion. Thank you.
See ya. So I'd just like to invite Joe to join Steve and just to take some questions from the floor, really. So feel free to raise hands and we'll send you a microphone. Okay, no, that's good. Well, whilst you were talking, I was curious to ask a question really around the modelling tools that you create. So as you're often you're referring through your presentation to having a dynamic, agile model, flexible model. How do you do that? So how do you create a tool that can take all of the demands and the drivers that you've talked about in the presentation, the huge variety of them, and then turn them into something that will ultimately measure viability?
It's very difficult. Hello. It's difficult, that, and if it was easy, then everybody would be doing it from a modelling point of view. I think a lot of that comes from experience and knowledge and know-how of what is important and what isn't important. The levers that you should concentrate on pulling and the levers that you should perhaps not be too concerned about. And then the word dynamic, which I used in the presentation there, what you don't need to do is create a model that's so complex that if any changes occur during the development of the scheme, then you've got to spend a week then deconstructing the model and putting the model back on. So we've obviously got a model that does everything that I've said there, but we've put a front screen onto that model that you can then put all the levers on that front model that you just switch, and then it gives you the answer dynamically of if tariffs were increased 10%, if tariffs go down 10%, etc. And we've identified what the main effects of the model are. So capital, OPEX, REPEX, etc. And we've learned to flex those in the way that we need to.
Just to come back on that point then, in terms of gathering CapEx information, OPEX information, you touch on not necessarily engaging with the market until later in the process, but ultimately you're going to need some market intelligence to inform your model, be that in charges to customers, connection costs, be that in construction costs. How do you feed that data into the model, bearing in mind you're potentially not engaging with the market in a manner that allows you to get real data? So how do you run those processes in parallel? Because I think it touched on some of what Polly was talking about, how they felt they were doing lots of things at the same time.
It's experience, essentially, and previous knowledge and previous engagements with, you're not reinventing the wheel every time you create a commercial model. And so capital or an average of the capital that is input, and critically, each one of those inputs will then have a tolerance of 10-15%, for instance. And so you can go down the medium route and say, well, this is our opinion of what this is going to cost, both REPEX, OPEX and CapEx wise. You then engage with the market, and the market might be 5% higher than that, 5% lower, and that's the boxes that you then tick once you've got the answer further down the line. And then you know how to, or you then understand, well, if that's the case, well, can we move something in the other direction, etc.
Great.
So it's experience.
It's fair to say, whilst he says it's not a complicated model, this model has evolved over 3 years. So all of the inputs from all the projects we've worked on with yourself and others, and pricing and information around the market and tariffs, that has been input into the model that is now we are using day to day. But this model came on the back of many models previously that were complicated, that were needing to be rewritten every time. So we then invested heavily into getting to a model that could do all the things we needed it to do with the market changes that we're seeing, with the changes to pipe code, the commercial structures, etc. So, but it's based on real data. That data just has to be refreshed every time we're tendering and checking the real prices against the market.
I think that's probably the key, isn't it? You recycling information, tweaking it accordingly, but it's being fed into a process so it becomes robust. Yeah, great. Any questions from the floor? Nick? Be kind, Nick. Yeah. You're on next.
No, I was interested in your upside down flow diagram, the V shaped, and starting with drivers. And you mentioned that certainly in the London market, where developers are often mandated to put district heating in, that some of their drivers are changing. You mentioned about developers not looking so much to take an investment contribution from an ESCO, but more to provide the value back to customers. Do you see that as an evolving model, or do you think developers have just been criticised for overcharging customers, or what do you think is driving that behaviour, let's say?
Developers are financially driven, and that is the crux of the answer. However, there is hassle involved with overcharging customers, or being seen to be understood to overcharge customers. And so the hassle factor, specifically in a few items in London, a few jobs in London, has been worth not taking the investment the ESCO. And so there is a benefit to the developer if they are the long-term owner of the ESCO to actually have happy customers rather than 500,000 worth of investment or £1 million worth of investment. And so I think it's been driven more so by the hassle factor, that they would rather have happy customers and it's better for their brand.
Great. Well, we're going to end questions at that point, and obviously if we find you over lunch, we can ask a few more. Thank you very much, Joe. Thanks, Steve.